Hello friends. Last week in my video, we tackled the issue of whether the war in Israel could basically drag the markets lower. And sure enough, like I told you, much will depend on whether the conflict remains confined to Israel on one side and Hamas and possibly Hezbollah on the other hand. But if it was to become a broader fronted war where more and more players were to rope in and squeeze in the activities, then the markets could get nervous. And sure enough, fears of Hezbollah and fears of Iran and US getting involved kept markets on tenterhooks. But are these the only worries that are facing the markets? Because markets are very cold, very calculative, and very profit oriented entities. Of course, I know the market as a collective term is a artificial entity, but it's a capitalist place, and money and profits are everything. So markets calculate profit and loss potential very cold heartedly, and big money is invariably one step ahead of the crowds. And big money is sensing a problem, especially in interest rate sensitive stocks. Friends, on our free Telegram channel, I have been warning you since months that interest rate sensitive stocks, especially banks, NBFCs, companies that are very, very heavily leveraged with debt, and those companies that rely very heavily on EMI based selling. These companies might just see a compression in stock prices. And sure enough, as you can see in the graphic, interest rate sensitive stocks actually have underperformed the broader markets, both on a Nifty and Bank Nifty relative comparative basis over the last 4 weeks. And I fear this relative underperformance might continue. So if you're owning any of these stocks, you would basically find this video very interesting and very educative. What you are seeing on that video is the interest rate sensitive stock basket has fallen 4.23% against the Nifty declining 3.01% and Bank Nifty declining 4.04% over a 4-week period. Clearly, as I have been sharing with you since the last 2 weeks in my video, Bank Nifty has been underperforming the Nifty 50, which tells you that banking is the Achilles heel in the market. Let's not forget, banking and financial sector services have a 35.95% weightage in the Nifty 50. And we as pure traders should rely not on opinions, not on biases, but on statistics and hard data. And the hard data tells us that banking and finance is dragging the overall markets down. Of course, the IT sector with a weightage of approximately 14% is also very heavy. It's the second heaviest. And put together, banking and technology stocks are comprising 50% weightage in the Nifty 50. So these two sectors can just drag the markets lower. Now, I've been sharing graphics since a fortnight about the underperformance of the interest rate sensitive stocks, especially Bank Nifty versus the Nifty. And the more details are already in our free Telegram channel. So as to not take too much of your time in this video, do connect with me on our free channel, and I share a lot of views and thoughts there. Friends, the bigger issue here is the problem that banking sector is witnessing in the United States of America. Do remember on 16th of March 2023, I had made a special video about the 6 areas of concern that I had about banks in America and why banking stocks in America might lead the markets lower. And I also said this could clearly have an eclipsing effect on emerging markets, including India. So note how the large bank index in the US markets is now at below its low made during the crisis of the Silicon Valley Bank failure. And our own Bank Nifty is falling faster than the Nifty 50. Now, the issue that I want to take up in this video is, Can the banking segment problems that exist in America also be seen in India? And like I told you, banking and finance has 35.95% weightage in the Nifty. Can the Nifty be dragged down by exactly the same problems? If not, what else? So now the 6 areas of concerns that I shared with you about US banks was credit card loans that were rising, student loans and housing loans, auto loans, the junk bonds that these banks were owning due to the greed for higher returns, and the sovereign debt that they had accumulated during the COVID period of many underdeveloped countries which had no recourse but to pay high interest so as to attract foreign capital. Now, do these problems necessarily impact banks in India? Let's take a case by case study. Credit card loans, yes, they are rising, but we are nowhere as close to the crisis level that the US banks are approaching. You're hearing or rather reading stories and updates in the media about how credit card usage as a basket, as a whole universe of digital payments usage has gone up in India. And credit card debt is also rising. So that may be a slight concern, but nowhere as close to the US. Student loans in India, again, nowhere as close to the US. Housing loans, fairly safe as compared to the US. All right. So housing loans in India, not a problem. Auto loans rising, but then nowhere as close to as the US levels. Junk bonds, no, we don't really buy junk bonds in banks. Sovereign debt, the Indian banks don't really buy sovereign debt of other countries. But we do have a slightly different problem. And this is something that the RBI has talked about since the last few months. And I have been touching upon concerns about interest rate sensitives, particularly banks, in my Telegram channel. Initially, a lot of people used to basically point out to me that I was wrong. Now, the problem that I'm talking about and the problem that the RBI is talking about is the rise and a rapid rise in personal loans that banks are handing out. Why? Because personal loans tend to be unsecured, number one. Number two, because they are unsecured, they attract a higher coupon rate. Now, I have been telling you that higher cost of money, which is rising coupon rates, will compress the margins of interest rate sensitive stocks. Why are banks recording such spectacular profits then? Number one, they are relying more and more on personal loans, which are unsecured loans, and they are charging higher rates of interest as compared to secured loans. So their profit margins expand. Number two, and a bigger reason actually, is that banks have two streams of income. One is fund-based, one is fee-based. Fund-based is you borrow money from a fixed depositor and lend it out to a borrower. The difference between what you pay on an FD rate and the interest that you charge to a borrower is your net interest margin. That is fund-based activity. Fee-based activity is the service charges that you collect and the fees that you earn. So if you're withdrawing money from an ATM and paying a service charge, that is fee-based income to a bank. There is no raw material cost there. There is no risk of loss or risk of capital involved there. Which is why fee-based income is so dear to banks of late. So a checkbook charge, all right, the third party revenue is selling you an insurance policy, not of the bank, but of another person. A tie-up with a brokerage firm where you're encouraged to open an account and a medical insurance that you are buying in the bank's group policy with a third party insurance company. These are earning the bank's fee-based income. And that is higher markup profit. So banks' profitability is going up. Does that mean stock prices should also go up? Look at the largest bank in India, both in the public sector and private sector space. SBI is the biggest bank by far. It's 60% of all banking in India, period. What is the stock price of SBI telling you? You are the judge. So It is fee-based income that may not continue forever. We traders, we are brain warriors. We have to fight and win with our heads, with our ideas. And we cannot afford to be biased. So we cannot be perma bulls, we cannot be perma bears. We have to be perma right. It is only when we are right can we earn profits and put food on the table for our family. Because we can eat only what we can hunt. We as pure traders, of course, rely on no other income but trading. So we have to be right, and therefore data is the only thing that we can rely upon rather than opinions and biases. And data has been telling you that banking is in a bit of a spot, and banking is something that you'll have to keep watching. I explained to you why. The weightage itself should tell you that banks need watching. Friends, I now come to our regular market coverage, and I start with the market roundup. Coming up on your screen now is the weekly market roundup window, which tells you that the decline was led by the Nifty 50 for a change, and the Bank Nifty brought up the rear. The US dollar index continued to rally, and it went up 42 basis points. The USD INR also rose 13 basis points, which means that the rupee was weaker against the US dollar. That added to the pressure on the Indian markets because we are net importers, and landed price of imported goods goes higher, resulting in imported inflation. Now, since the US dollar was higher, crude oil fell, and natural gas rose. But to those who do not know what commodity trading is, most of the rally that has come in the price of natural gas, which appears to have come rather, is because of cost of carry. Now, October series has expired and November futures have started. The difference of approximately 30 rupees is what was seen as cost of carry from October to November, and that's got featured in and appearing as a huge 22% rise. That's what you need to cut through the smoke of. Gold went up due to safe haven buying, and silver came down marginally. I think if the war is to get escalated, bullion is likely to see defensive buying. Let's not forget it's Diwali season, where in this part of the world a lot of buying comes in. 10-year benchmark bond yields fell 1 basis point, and the market fell 2.74% where market capitalization is concerned. Friends, I have talked to you last year about why I think the 4% decline in market capitalization is a danger zone for me. Whenever I have seen 4% or higher declines for 2 or 3 consecutive weeks in market capitalization, the onset of a bear market is very highly likely. So we are not there yet. It's 2.74%. Let's watch. MWPL fell routinely on expiry of the October series, and the US market indices, all three of them fell, thereby providing headwinds to the domestic markets. Friends, I now come to our in-house indicators, starting with the MWPL. Now, the MWPL has fallen, which is routine after expiry of the October series. But look at where it's fallen. It's now at a 4-month low. At 26.88, it's the lowest after June expiry. I have been telling you that risk appetite by way of MWPL was way too high, and high MWPL always triggers higher volatility, because whenever push comes to shove, you have that much bigger exposure to unwind and square up. That leads to higher and bigger volatility clusters and bigger price moves. And sure enough, what you saw last week, I believe, was just a trailer. A bigger volatility cluster might just appear. I hope not. I hope to be wrong about this, but it is a possibility. Now for the index and stock futures turnover. Remember, these are 3 concurrent series. So it's October, November, December. What we are seeing is turnover in stock futures went up sharply. It is also actually routine because every 4 weeks you will realize there is a spike here. People have squared up their positions in the October futures series and rolled them over to November futures, and therefore double turnover is recorded. Next week again, you'll see the turnover coming down. So the real signal will actually come next week. I now come to the advanced decline ratio, which after the price is the most reliable indicator of which way the winds are blowing. What you are seeing is that the Nifty fell 2.5%, which is near the highest decline in 20 weeks and covered by this chart. But the advanced decline ratio rose up to 1.29. Now, a word of caution here. Before you start smacking your lips and saying, hey Vijay, the advanced decline ratio is above 1, and you always write on your social media columns and social media accounts that as long as the advanced decline ratio is above 1, bulls are in control. But do remember, A, it was a short week, 4 trading sessions, and B, the advanced decline ratio on Friday was 4. So if you take the average of the week, which is represented in this chart, do remember what the chart says. It's a weekly average. It's basically skewed or tilted more towards the weightage that Friday has indicated. Otherwise, believe me, the advanced decline ratio would have been below 1. So what we do need to see going forward is how the war news pans out. I now come to the basis of the prompt futures of the Nifty and the Bank Nifty. What is the basis? It's nothing but premium or discount present in the futures compared to spot. What you're seeing is the Bank Nifty basis at 261.40 is near the highest point in 20 weeks, and 84 rupees 10 naya paise on the Nifty 50 is also near the highest of the period. Can this high basis sustain? I think not. I think coming week itself, you will see a significant decline in the basis. This is just the expiry related expansion in basis because traders have 4 full weeks to trade and therefore they are paying a high premium. Sure enough, I expect the premium to go down starting Monday itself. Now, for our exclusive in-house indicator, the impetus, which you've been enjoying for more than 2 years now. The red color line is the Bank Nifty impetus, blue is the Nifty. What is alarming is that the impetus on both these indices has shot up. The Bank Nifty, as a matter of fact, has the highest recorded impetus in 5 months. And that's bad news. Believe me, I know what I have programmed into this indicator. I don't like what I see on the chart. What it very simply means is that last week's decline in the indices was extremely forceful. There was actually forced selling, very heavy selling on the indices, which is why the impetus has jumped where it has jumped. Can the impetus last here? No, I think the impetus will come down a little. But does it mean necessarily that the indexes or the indices will rise? Not necessary at all. It just means that the decline might slow down a bit. Can a short covering rally come? Yes. If there's news of a ceasefire, yes, a short covering rally may come. But this high reading of the impetus, believe me when I tell you this, you don't want to see this. This is bad news. Friends, I now come to another exclusive in-house indicator, the lift, weight, thrust, drag indicator, which you've enjoyed for 2 years now. And I have a lot of positive feedback. I thank you all for writing to me your warm words about this indicator. What you're seeing is that the Nifty has fallen 2.5%, which, like I told you in the earlier chart, is the biggest decline in 5 months. The LWTD has gone up to 0.44. Why is this? Number one, just like the advanced decline ratio, the LWTD jumped significantly on Friday. Because Friday you saw a huge run up, a gap up open and a run up. And this, like the advanced decline ratio, is a weekly average. So the weightage of Friday has taken the reading to 0.44. What if Friday was not such a big rally or maybe no gain, no loss? I think the LWTD would have still been above zero, but mildly above zero. What does it tell you? If you were to see the LWTD tutorial video, which is there in the description below this video and in the pinned comment, what you will see is that the LWTD is suggesting that there could be short covering on declines. Now that means downsides might get cushioned a little bit. Does it mean that there will be a full-blown rally? No, I'm not saying that, unless the war itself comes to an end or a ceasefire is announced. Short covering can cushion declines or slow them down. It takes fresh buying to cause a rally. Unless a fresh forceful buying comes in, I think a new high will be elusive. Friends, our in-house indicators done. I now come to the banking segment, the bond segment, which is actually at the crux of why the market has fallen as high, as hard as it has. You would have no doubt read about the US Treasury yields now hitting 5%. And if you don't know much about the bond market, which is very surprising because if you've been connected with me long enough on my social media accounts, I always talk about the bond markets before I talk about equities, because this market finances all the other markets. Now, what do you need as a trader? Highest amount of returns in the shortest possible time and with controlled risk. Now, why is the bond market in the US causing a decline in equities worldwide? Very simply, without risk, government guaranteed yields on US treasuries is 5% and the S&P 500 earnings yield is lower than 5%. What does it tell you? If you want peace of mind and higher returns, buy the US treasury at 5% because the S&P 500 yield is lower. Bonds are actually making more sense than equities now, and traders are fearing that people might sell equities in emerging markets, take the money out and put it back in the US markets. And in order for yields to become more attractive in the emerging market central bankers will have to increase their interest rates so that we offer a significantly higher rate of interest so people can pull money out of US at 5% and put it here. Currently, the Indian bond yield is 7.35, 7.36. But do remember, what appears to be a gross advantage of 2.25% to an investor, you need to factor in remittance charges round trip from US to India, India back to the US, hedging of the currency because the Indian rupee on a long period or LPA, long period average, has a history of depreciating 3.5 to 5% per annum. So you need to hedge your currency exposure, which is again another 2.5% per annum. So 2.5% per annum hedging charges, remittance charges, which means out of 7.36% bond yield, you take away almost 3%. What you would get is 4.3% compared to 5% available in the US. Would it make sense to invest in India on a cash carry basis? Means carry the cash from US to invest in India? I don't think so, which is why the markets are falling. Those who don't understand bond markets are at a serious disadvantage to those players as compared to those players who do understand bond markets. So please, I request you to learn as much as you can about bonds. Now, coming to the Indian bond yields, what you're seeing is we saw 1 basis point decline, but we are still above the downward sloping upper trend line of a triangle. And as long as we remain above the 7.27, 7.26% yield, I think the bias still remains upwards. Currently, I'm still not doing anything at all. I'm not laddered, nor have I gone for gilt funds. As and when I do, I assure you, I will be updating you on our Telegram channel first. Friends, the bond market's done. I now come to the Bank Nifty, which fell on 3 out of 4 trading sessions, and it fell 2.15%, as you can see on the daily chart of your screen. Friday, the only gaining day, was an outlier because it was a pullback rally. And the head and shoulder that I have marked on the daily chart, which you can see on your screen, there are actually 2 head and shoulders. one that started in June and the other that has started in August. So the August one, being more recent, is now established and activated as a resistance area now. The price has fallen below the neckline starting from Monday itself. Last week, I suggested that a 2000 point decline could actually occur in the Bank Nifty if at all push came to shove. And what you are seeing is at least half of that decline has already occurred. I have marked the distance between the head and the neckline as a measuring move, as you can see indicated by an arrow, and replicated that same quantum as a possible target, which is how head and shoulder price objectives are forecast. And that comes to approximately 41,325 mark. I'm not saying that is going to come for sure. I'm not even saying it's coming if it is coming in this week itself. It could take time, it may not even come, but this is the head and shoulder profit target for short sellers. Now, the price is also below its month-long moving average, which itself is turning downwards. So the collective evidence, weight of evidence of head and shoulder and price below the moving average tells you that the short-term outlook is weak. Friends, I now turn to the weekly chart and it shows the bullish wedge formation, which I indicated to you last week, has now been conclusively violated. Last week, we were at the lower trend line, prior week rather, and last week we've actually breached that trend line and closed lower. The price has closed below its 25-week exponential moving average, which is a 6-month long holding on cost of an average buy and hold investor. So the medium term outlook has also been weakened or become nervous. Add to that cost of carry if you're a buy and hold swing trader of the Bank Nifty futures, and you seriously have a problem. Note how the interest rate sensitive stocks are underperforming the Nifty 50, and you will know what I mean when I say that banking is really the weakest link in the chain of the markets. Friends, in the week before last, the Bank Nifty ranked number 6 on the most volatile counters list as per statistical beta measuring that we keep in-house. It jumped 3 notches to number 3. What does it tell you? It tells you that beta, statistical beta or pure price volatility jumped through the roof. Challenge level to traders has risen by a factor of 50 to 70%. That's how difficult it will be to make money, because trends will be fickle and prices will move against you at the drop of a hat. This is all thanks to what I have been observing in my live mint column, that when MWPL goes up sharply, whenever unwinding occurs, that much more unwinding will occur and price movements will be very, very large. Last week, I advocated estimated range between 44,800 on the upside and 42,650 on the downside. Admittedly, I missed that target by almost 550 points, because the low was 42,105. In the coming week, I expect an estimated range between 44,425 on the upside and 41,150 on the downside. A caveat here, these are war times and these levels might be violated. So let's be careful out there. Also, please refer to our daily, weekly and monthly pivot levels on our free Telegram channel, which will help you trade much more accurately, whether you're options or a futures trader or a swing or an intraday trader. So do make a note of that, please. Friends, the Nifty done, the Bank Nifty done, I now come to the Nifty 50, which fell 2.53%. And like the Bank Nifty itself, fell on 3 out of 4 trading sessions. Friday again being an outlier. It was a gap up day and a minor saving grace for the bulls. Price is below a few critical levels. Number 1, note the flag formation that has occurred in July and August. I have marked the flag formation low at 19,224, which I have pointed out to you in the last few videos. We now have violated that low and closed below it. Secondly, We are below a 20-day moving average, which is a month-long holding on cost of an average short-term trader. And the average itself is turning downwards. So the short-term outlook is nervous. Can there be a pullback? Yes, there can be, especially short covering triggered by a ceasefire or end of the war. But we need to watch banking and financial sector along with technology. Remember, 35.95% weightage of banking and finance and almost 14% in the IT sector in the Nifty 50. So the war may not be the only problem that you have on your hands. Coming to the weekly chart, what you are seeing is that there is a bump and run reversal marked by two red dashed trend lines. The number one is a shallower trend line of a longer duration, and the internal trend line of a shorter duration is much more steeper. What you're seeing is that the steeper trend line has been violated, which I've marked as a bump and run reversal with an arrow. Now that the steeper trend line has been violated, the tenets of bump and run reversal formation tells us that estimated target could be as low as 18,400 if push comes to shove. Now, that of course will depend on news of the war and overseas markets, etc. The price is below its 25-month exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook is also nervous. Now, in the week before last, this index was number 14 on our most volatile counters list, which we maintain in-house. It jumped 7 notches to number 7. Now that means volatility has doubled on this counter, and so have the challenge levels. This is another example of how MWPL results in higher squaring up and higher volatility. Can there be a crowded exit risk where everybody is rushing through the outdoor like a cinema hall on fire? I've discussed about that in my podcast on our free Telegram channel. Do refer to the crowded exit phenomena there. There is a slight chance, I'm not betting on it yet. Last week, I advocated an estimated range between 19,925 on the upside and 19,150 on the downside. Here again, the downside was breached because the low was 18,838. In the coming week, I estimate a range between 19,650 on the upside and 18,425 on the downside. Here again, the levels might be breached due to high volatility. Please do refer to our pivot daily, weekly, and monthly pivot levels as futures and options traders. Whether you're a swing or an intraday trader or an option writer, it should help you. And cut down on traded exposure. These are not times you want to take big risks. Friends, I now come to the last bit of statistical evidence which I share with you based on the traded turnover contributed by the four segments in the FNO. What you're seeing is the index futures turnover contribution went up by 5 basis points, which is indicated as a blue line. The stock futures turnover went up by 15 basis points, which is indicated as a red line. This is primarily because of expiry, and like I said, people squared up their trades in the October series and rolled them over to November, so the turnover logged was double. Index options turnover went up 20 basis points. Index options are the least risk volatile and least risky compared to the entire basket here. And stock options turnover actually collapsed by 40 basis points. So very clearly, traders were going in for the lowest risk instrument, which is index options. Risk appetite is down. Friends, I now come to what I would do in the market as my trading strategy in the week ahead. First and foremost, I will cut down on traded exposure. This is what I said even last week. These are war times. I don't want to get the award for bravery here. I'm here to survive and make money, not act tough as a trader. Now, my concerns continue for interest rate sensitives, where I will prefer to persist with my theta decay strategy in the options segment. If at all you have a limited risk appetite, you might want to have tail risk hedges. So a tail risk strategy would mean that you would buy deeply out of money call options at very small premiums. So, for example, if the Nifty is trading at 19,000, you would write a call. These figures are hypothetical. I'm not recommending a trade, do mind you. So, you would write a call at 19,500, which is where the premium would be higher, and you pocket the premium because you're writing it. And you would buy a deeply out of money call at 20,500, where the premium will be small. So, if at all the bank Nifty goes up, the Nifty was to go up against you, you would basically have some amount of cushion. Like I said, this is a hypothetical example. So, metals may see a small bounce back on short covering because the month is expiring on commodity exchanges. That may show up on stock prices of metal stocks too, but it's too early to call for a reversal, a bullish reversal in metal stocks. PSUs will continue to remain in the limelight due to the very high MWPL that I'm still seeing on our statistical trading model, the IBEX. And that will assure that there are big moves in either direction. Do remember, wherever there's a high MWPL, there's high emotion and high financial involvement in those particular counters. Whenever things turn turtle, whenever things go against the trader, this is where flight to safety occurs the most. This is where the market becomes the weakest, and I want to exploit that in case it does. So I will focus on PSUs. Oil and gas will be news dependent, but higher levels are encountering selling in oil. Gas appears to have risen, which I told you, due to the high cost of carry of 30 rupees. And bullion may continue to be supported by defensive buying on declines. A, there is war. B, there is Diwali coming up. And I think the Indian rupee is looking a tad weak in relative comparison to the US dollar. So this is something that we need to keep an eye on. If the rupee was to weaken against the dollar, markets might just take a bigger fall in the coming week. Friends, before I say goodbye to you in this video, a reminder to subscribe to our YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how you like my videos and how it helps you to become a better trader. Also, help me reach out to fellow like-minded smart traders like yourselves by sharing my video with your family and friends. Thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable week ahead. Take care. Bye-bye.